Hey, everybody. Welcome back to Property Nirvana. This is Brian Carmody, one of the co-founders, and I'm here with Tom Graziano, Managing Director at Stacksource. You can find them at stacksource.com. Commercial real estate lending extraordinaire website and all kinds of great goodies there. I got Tom on the line today to talk a little bit about what Stacksource capabilities are. And we're going to go into a little bit about what a borrower should be looking for, what an investor should be looking for when they get a term sheet, basically. What are the key metrics to look at and in order to figure out what's a good offer or not, what's a good deal. Okay. Tom, why don't you tell us a little bit about you and Stacksource, and we'll go from there.
All right, great. Thanks, Brian. Thanks for having me.
Yeah.
Again, I'm Tom Graziano. I'm with Stacksource. Stacksource is an online commercial real estate financing platform. We're not a direct lender. We work with borrowers in arranging financing for their projects. The process is, very, fast, easy, and most importantly, transparent. Borrowers can come to the platform, upload their deal, and in the process of uploading the deal, all the details, property type, loan amount, location, what kind of loan they're looking for, whether it be a bridge loan or a perm loan. We have an offline database of lenders, and based on the inputs of the deal, that offline database will narrow down and funnel to determine which lenders are best suited for any given deal. So once a deal is uploaded, they'll click submit, then we're notified on our end, and then we'll respond with a few more questions, just try to get a fuller picture of the deal and the borrower themselves. Typically, we'll set up an initial intro call and just work it out, just kind of qualify the deal on our end. And then once all the inputs are in the on the project page, we can then activate it and send it out to the lenders that were matched. Lenders have been uploaded to our system based on their parameters, so they're only going to receive a deal that meets their criteria, right? So when they're notified to say, "Yo, we have this new deal that we want you to take a look at. It should be up your alley based on your parameters. It's worth taking a look." They can then access the project page where everything is laid out in a great user interface with all the pertinent info. Basically everything you would get in an offline, like a PDF OM, but it's all laid out on our platform. So they can review everything. If they like the deal and they want to submit a quote, they can do so right on the platform itself. And when they do that, we'll get notified, as well as the borrower, saying XYZ lender has presented a quote. The ultimate goal, obviously, is to present them with, a handful, 3, 2, 3, 4, 5 quotes, and they can analyze those options right on the platform. We have a great interface, like I said, where they can, compare them in a quote matrix. Like I said, so compare apples with apples and see which lender's offering what. And then ultimately they can say, all right, I like this lender. I want to go with him, click, accept. And then the process to closing starts. And we kind of usher the deal, from beginning to end.
Nice. So I like how you're matching lenders and borrowers up by parameters, because there's so much, I guess, generic advertising out there of generic programs, right? Just like, hey, I get emails all the time from lenders saying, here's our latest program. And it's like, bing, 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 bing. And it's got all these great terms in it, but it's like, again, it's not very personalized. And I like how you guys take care of that step, which is good.
Yeah, and it's a live offline database where, when I say live, I mean, we're constantly updating it to make sure we're up to date with what lenders are offering.
Because that does change.
Yeah, sure. Like during COVID, a lot of guys were on hold for a while, right? So sure enough, we had that little note in our database, letting us know that, so they weren't receiving deals. Let's say it was a nationwide lender, but they were only focusing in a couple states, right? So we made sure that was noted. People's rates often change, their max leverage often change. So it's our job to constantly be in touch with those folks and make sure that we have the most up-to-date information in our system, which will makes the whole platform work a lot better. And and borrowers and lenders alike really like that process.
And did you say how long the process takes from an investor borrower submitting an application to hearing back on terms?
Yeah, oftentimes the holdup is collecting the data. We have borrowers that are forthright, that they'll provide everything up front, all property related info, their personal financials, any market info, and there's a feature to upload all that information right to the platform.
Yep.
But sometimes it just takes a little back and forth to collect that information. Obviously, with an acquisition, if it's a marketed deal, they might have a sales broker OM, or some other readily available information.
Yep.
Other times it's an off-market deal where they may not have access to the property financials. So we have to kind of work around that and get a good sense of how the property is performing to kind of build out our own pro forma. But like I said, if everything is uploaded and ready to go right off the bat, we can send it out to lenders, and some guys will get back to us within an hour, right? I often will say we'll have some definitive feedback within the first 24 hours. But like I said, it's deal dependent, borrower dependent, lender dependent. Most of the time.
Yep. It's input in how much good, accurate info you collect up front is always going to be beneficial. It's one of the big reasons why, as a commercial real estate mortgage broker myself, why I wanted to start Property Nirvana was to kind of educate, the investors out there to be better prepared. There's a lot of great savvy people that have some great insights on picking out good deals, but when it comes to actually coming to ask for money, they're just they're kind of in a closet with the lights off, and they need a flashlight. So
sure, and you can imagine a lot of times borrowers might not want to provide their personal financial statements right off the bat, and it's understandable.
Yep.
But it just, if we get everything, it certainly helps expedite the process and ultimately get them feedback and get the deal moving. So
right. Awesome. Tom, what should term sheets obviously come with a lot of information on them. What particular metrics would you zero in on, or would you advise a kind of a newbie investor to really pay attention to figure out which is a better deal, when you're looking at the different, say they get 2 or 3 options, talk a little bit about that.
Yeah, so a lot of times the biggest key metrics that folks tend to focus on are the interest rate, loan to value, how much leverage they're going to get on the deal, the amortization period that the deal is going to be on, and some other is it whether it's recourse or non-recourse. We try to collect that information up front. Some guys can specify what it is they're looking for, or others will say go out and give me the best rate, max LTV, right? That's usually the mantra. Yeah. And when folks come in, a lot of times they will focus solely on the interest rate, which is a big factor, of course, but they got to realize that there's other things that play into it: leverage and the amortization. Mm-hmm. Most deals, bank loans, for example, you're going to see 25-year amortization. Some deals, could be lower, and the like CMBS, for example, are typically 30-year amortization. A lot of banks, and there's a lot of more private lenders out there offering a 30-year product. And what I try to focus guys on is that the interest rate alone, you can't look at it in a vacuum, right? The amortization plays into what your annual debt service payment is going to be. And that's, when it comes down to it, that's the dollar amount you want to focus on. Yeah. So when I try to explain it, because we're trying to compare apples with apples, right? So you might have one deal that's a 4% rate on a 25-year rate, for example. Okay. And then the other option they get is 5% on a 30-year rate.
Right.
So right
higher rate, but longer term, right?
Okay. Or longer amortization. Let's assume a 5 or 10-year term deal, right? Okay. Typically the deals are structured on a term basis, 10-year loan on a 30-year amortization, where at the end of 10 years, you're going to have a balloon payment, right? Okay. So the amortization will factor into what your debt service payment is going to be. Mm-hmm. So if we're looking at a 4% rate, again, assume a 10-year deal on a 25-year AM, and another, same thing, 10-year deal, but it's a 5% rate on a 30-year AM. Maybe a newcomer might not realize what difference that is when it comes down to their actual dollars they're going to be paying for that loan. Right. And that metric that comes into play now is called the loan constant. So the loan constant is a huge metric in that it factors in both the interest rate and the amortization. So it's going to ultimately, I like to describe it, it's more your true cost of capital, right?
Yeah.
You can't just look at the interest rate because you have to factor in the amortization.
Yep.
So so the amortization schedule will ultimately include your interest and principal payments, right?
Yep.
So it factors in both. So right off the bat, they might have a little sticker shock, right? And they say, "Oh, I want the 4%." Well, I said, "Oh no, you have to look at it a little closer because even though the other option is 5%, you have it's spread over a longer schedule, right?"
Yeah.
So, and then you kind of give the example just to put it in dollars and cents. You say, a 4% rate on a 25-year AM, the loan constant is going to be 6.33%, right? So you look at it, the way you get to that number is you take your annual debt service and you divide it by the loan amount, right? So that generates the loan constant. So if you were to take your loan amount, multiply it by that loan constant, right, just the inverse, you would get your annual debt service payment. So on a 5% deal on a 30-year AM, you're looking at a loan constant of 6.44%, right? Again, higher, just because granted, considering the higher rate plays into it. But if you're assuming $1 million loan, you're talking about it maybe $1,000 a year difference, right? $90 a month. That's quite, it's pretty nominal, right? So the sticker shock shouldn't really get to you because you have to factor in both. And it's and again, the loan constant is just one of the metrics to keeping your toolkit when you're analyzing these, rate. Then on the buy side, obviously you're looking at the cap rate and your IRR when you're looking at your full equity model. But the loan constant is a key metric that folks tend not to know about or use in their analysis, which is extremely important.
So take home message really is, when you're looking at a term sheet, don't just look for the rate and then turn your brain off once you find that number. There's a lot more to the equation because it is an equation. You can tell there's 3 different parts to it that all factor into it, and you got to look at all of it.
Yes, everybody knows, interest rate is usually the buzzword when you're talking amongst peers in the business, even on the home loan market, right?
Right.
When rates have been coming down so much, folks like, "Oh, I just refied at 3%. Oh, I just refied that," and the guys, "Oh, it's refied at 2.5%." And you say, "Oh, what kind of is it? A 30-year loan?" And you say, "No, it's a 15-year loan." I said, "Okay."
Yeah.
Using that, if we want to use an extreme example of what we're just talking about on $1 million loan amount, if a guy had 2.5% and it was on a 15-year amortization, the loan constant would be 8%, right?
Yeah.
He'd be paying $16,000 more a year. Granted, you'll pay the loan down faster,
right?
But a lot of guys want to see what their free cash flow is going to look like, current, right? So they want to, the lower the loan constant, the lower your annual payment is going to be.
Bingo. Right. So yeah, it's a great analogy is came up when you and I had talked about this in the past, it's that the rate kind of serves you well in the cocktail party atmosphere, right? It's just an easy, simple metric to key in on. What rate did you get? What rate did you get? 4%, 5%. It's just easy to kind of talk about, but and
another a good kind of comparison is when you hear interest only loans, right?
Yeah.
On an interest only loan, if you get an interest rate of 5%, that in turn would also be your loan constant, right? Because there is no amortization.
Right.
So that just shows because you're only paying interest payments, you're not factoring in the principal payments.
Yeah.
So again, it's just more how folks can see what that loan constant actually means.
And again, you gotta, as an investor, look at what is your end goal here. It's all strategy. So what is your end goal? Is your goal to pay this note down as fast as possible? Okay, that's one thing. Is your goal to generate cash flow now? Then okay, that's another set of loan terms that are going to support you that way. So you got to look at the whole thing, look at the big picture, and look at the lots of factors that go into it. Plus the down payment could be a bit different on different each of those different variations too, and that's going to affect what you want to do as well.
Oftentimes it can be a short-term bridge where borrowers will only want leverage, right? They don't care what the rate is, because at the end of the day, if it's a 12-month loan, the interest rate is, important, but you're only paying it for a year. They want to get as much leverage as they can, and therefore put as little cash down on the project.
Right.
But for a perm loan, you definitely have to focus on all the metrics at your disposal.
Yep. Awesome. Well, Tom, great talk here, and lots of good learnings here for new investors and even investors who've been doing it a little while and maybe probably picked up a few pearls on this too. You can't ignore the math and the different things that funnel into the equation of a term sheet and what makes a good loan, and again, keeping your end goal in mind to figure out what's right, because it's not a one size fits all kind of a deal. So,
right. And that's part of our job, as at Stacksource, as capital advisors, is to walk, especially folks that are new to the business, probably, is to walk them through the process and educate them and be here to answer any questions you have. And the platform is great for the newbies as well as more seasoned investors. So when it comes down to it, the platform really helps expedite the process, and is just a great resource to kind of take the old school way of doing things and move it into the 21st century,
the digital age.
Digital age, right? And but as we all know, commercial real estate is much more nuanced, right? So you can't have the same kind of tools you do on the residential side, where you can just plug in your credit score and your address and get a loan quote. And get pre-approved, for example. Commercial real estate is certainly a different animal.
Yep.
So we're trying to kind of just make that process much easier, much more transparent than it has been. For how for a century, right?
Yeah. Right.
So
awesome. Well, folks, find Tom and his great platform at stacksource.com. And you'll be hearing more from Tom in these Property Nirvana member spotlights that we do. Tom's a member of Property Nirvana, and you'll probably see some other ways he'll be contributing as well to the platform. So great guy to learn from. As you can tell, easy to talk to, and definitely has your best interest at heart. So not trying to force any kind of specific program down your throat, but to find what's best for you. So great. That's the best part of the relationship. So, Tom, thanks so much for your time today and your knowledge.
Brian.
Okay, man.
Thanks for having me.
All right. Be well. Thank you.
You too.
Bye-bye.
Thanks.